By the mid-1960s, two of America's most storied railroads were bleeding money. The Pennsylvania Railroad, once the self-styled standard railroad of the world, and the New York Central, Cornelius Vanderbilt's old empire along the Hudson, both faced the same structural problem. Automobiles and airlines had taken their passengers, and interstate highways were taking their freight. Regulators and bankers pushed the two rivals toward each other. The theory was that combining operations would cut costs fast enough to stop the losses. Penn Central Transportation Company was born on June 1st, 1968, becoming the largest railroad in the United States by track mileage and one of the largest corporations in America by assets. The two railroads had spent decades competing and, in the process, had built entirely different operating cultures, computer systems, and labor agreements. When the merger closed, locomotives from one company could not communicate efficiently with dispatchers from the other. Freight cars wandered yards without reliable tracking. The Pennsylvania's operations-focused management clashed immediately with the New York Central's more financially oriented leadership. Stuart Saunders, the Penn Central chairman, and David Bevan, the chief financial officer, later blamed each other publicly. Contemporaneous accounts, including the 1971 book The Wreck of the Penn Central by journalists Joseph Don and Peter Binzen, describe a company where basic logistics broke down within months of the merger closing, producing operating losses far larger than any pre-merger projection had anticipated. The operating losses began almost immediately and grew faster than management had projected. What made the situation worse was that Penn Central's leadership continued to pay dividends and reassure banks and bondholders, while internal documents showed the company hemorrhaging cash. Bevan faced criminal charges in the aftermath, though he was not convicted, related to allegations that losses had been misrepresented to lenders. The Interstate Commerce Commission, which regulated railroads, later found that Penn Central's reported results had obscured the true financial condition from the public and from the government agencies that might otherwise have intervened earlier. To keep the railroad running while it bled money, Penn Central turned to the commercial paper market. Commercial paper is a short-term unsecured promissory note that large corporations issue directly to investors, typically with maturities of a few days to 270 days, bypassing bank lending entirely. By 1970, the commercial paper market in the United States had grown to roughly $33 billion outstanding, according to Federal Reserve data from that period. The attraction for borrowers was cost. Commercial paper rates were usually below bank loan rates. The attraction for investors was yield, slightly above Treasury bills with the implied safety of large, recognizable corporate names. Penn Central had accumulated roughly $82 million in commercial paper outstanding, according to accounts including a Federal Reserve history essay on the episode, using the proceeds to fund day-to-day operations. By early 1970, the true financial condition was becoming harder to conceal. Penn Central approached the Nixon administration for a federal loan guarantee, arguing that a railroad of its size was essential to national defense and commerce. Secretary of Defense Melvin Laird initially signaled some support, citing military supply considerations. But when the numbers were presented to Congress, lawmakers were resistant. Representative Wright Patman of Texas, a longtime critic of concentrated financial power and then chairman of the House Banking Committee, was among those who questioned whether taxpayers should rescue a company whose management had continued to pay dividends while concealing losses from creditors. Congress declined to authorize the loan guarantee, and without federal backing, Penn Central's remaining options were exhausted. On June 21, 1970, Penn Central Transportation Company filed for bankruptcy protection under Section 77 of the Bankruptcy Act, a provision specifically designed for railroads. It was the largest corporate bankruptcy in American history up to that point. Contemporaneous accounts placed total assets in the range of $6 to $7 billion, though the exact figure varies across sources. The filing itself was not entirely a surprise to the financial community. Rumors had circulated for weeks. But the timing mattered because Penn Central had roughly $82 million in commercial paper maturing in the days and weeks immediately following the filing, and those obligations were now in default. The shock that rippled outward had little to do with railroads. Investors who held commercial paper issued by other large corporations suddenly asked a question they had never seriously considered before. If the biggest railroad in America could default on its short-term paper without much warning, whose paper was actually safe? Institutional investors and corporate treasurers began refusing to roll over commercial paper for dozens of companies. Chrysler, already under financial pressure from its own operational problems, found it could not place new commercial paper. Other industrial companies reported the same difficulty. The commercial paper market, which had functioned on the implicit assumption that large corporations simply did not default on short-term obligations, seized in a matter of days. Federal Reserve Chairman Arthur Burns, who had taken office in February 1970, faced a liquidity crisis that threatened to spread from commercial paper into bank lending and then into the broader economy. The Fed's response had two main components. First, it temporarily suspended the interest rate ceilings on large certificates of deposit under Regulation Q, allowing banks to raise CD rates high enough to attract funds that could then be lent to companies shut out of the commercial paper market. Second, the Fed signaled clearly to member banks that it would support them if they extended credit to otherwise sound companies that could no longer access commercial paper. This combination, taken over the course of several days, gradually restored confidence in the short-term credit markets and prevented the freeze from spreading into a broader financing crisis. Penn Central remained in bankruptcy for 6 years, a prolonged reorganization that became one of the most complicated legal proceedings in American corporate history to that point. The railroad's infrastructure was so important to the northeastern United States that simple liquidation was not a realistic option. In 1976, Congress passed the Railroad Revitalization and Regulatory Reform Act, and Penn Central's core rail operations were folded into a new government-created entity called Conrail, the Consolidated Rail Corporation. Conrail operated as a quasi-public entity until 1987, when it was privatized in what was at the time one of the largest initial public offerings in American history. Penn Central's non-rail assets were eventually reorganized into a separate company that survived as a real estate and financial holding firm before being absorbed by other entities in the 1990s. The Penn Central episode forced regulators and market participants to confront the fact that the commercial paper market had been operating on reputation and assumption rather than rigorous credit analysis. In the aftermath, the Securities and Exchange Commission clarified disclosure obligations for commercial paper issuers. More significantly, the ratings agencies, particularly Moody's and Standard & Poor's, expanded their commercial paper rating services, and investors increasingly required ratings before committing funds. The informal trust that had held the pre-1970 market together was replaced, over time, by a more structured system in which creditworthiness was at least nominally assessed before investors purchased short-term paper. The market itself continued to grow, but the operating assumption that large company paper was risk-free had been permanently revised. The reason the Penn Central episode matters beyond railroad history is that the same market broke in the same way in September 2008. When Lehman Brothers filed for bankruptcy and the Reserve Primary Fund broke the dollar, institutional investors again refused to roll over commercial paper for companies they had funded without hesitation for years. The Federal Reserve's response was, in structure, a direct descendant of 1970. It created the Commercial Paper Funding Facility, a Fed-backed vehicle that purchased commercial paper directly, supplying the liquidity backstop that private investors would no longer provide. The 2008 facility was larger, more formal, and operated under explicit statutory authority that had since been clarified. But the underlying logic, the central bank stepping behind a short-term debt market that private actors had abandoned, was the same intervention Arthur Burns had improvised 38 years earlier. If you hold money in a money market fund, there is a reasonable chance some of that fund's assets are in commercial paper issued by large corporations and financial institutions. The Penn Central episode and its 2008 echo illustrates a structural feature of short-term debt markets. They can function smoothly for years on implicit trust, and then seize almost immediately when one large default breaks that trust. The regulatory responses after 1970 added ratings requirements. The responses after 2008 added liquidity requirements and the authority for money market funds to impose redemption gates during stress. Whether those additions are sufficient is a question the historical record cannot yet answer. What the record does show is that when these markets freeze, the entity that has stepped in to provide liquidity is the central bank, using authority that was first improvised in 1970 and formalized over the decades since. Knowing that history is part of understanding how the financial system actually works.